The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Julia Lee. Tonight on the program I'm joined by Stephen Hogan of Nervous Capital and also Russell Muldoon of Montgomery Investment Management. So if you've got a question about shares, our phone lines are open and the number to call is 1300 30 34 35, or if you prefer you can also email us on yourmoney@skynews.com.au. Once again, we've seen an extremely volatile market which is firmly focused on what's happening in Europe and also growth rates out of China as well. In fact, since the 2nd of May, we saw the market losing 8.8% in 2 weeks. Thankfully, over the last couple of sessions, we have seen a bit of a relief rally, but I guess the big question for investors and traders out there is whether it can continue. So let's ask our expert panelists tonight. I mean, Russell, looking at this market, and we've seen 2 consecutive days of gains for the Aussie share market, but in comparison to that big, very sharp sell-off that we saw, it's quite tiny in comparison. Is it just a short covering action that we're seeing, or are we seeing the start of a bit of interest in shares?
Else. Yeah, look, unfortunately that's not the way we look at the market. We don't focus on the overall index. We don't look at the index and invest index. We invest in companies that make up that index. So our job is a lot easier. We don't I guess get confused by the red headlights hitting the screen over the last few weeks. We find it much easier just to focus on individual businesses, and over time we're guaranteed to outperform the market if we do that and stick to high quality businesses. I'll just give you an example. On Friday our index was down 2.6%, our portfolio was down 0.3%. Now, yes, our portfolio was down, but it was down significantly less than the market because we own such a high quality portfolio of businesses. So it doesn't matter what happens in Greece, in Europe, in the US, in China, as long as we continue to build a portfolio from the ground up of high quality businesses, we think we'll do well over time. I don't know if you remember, about 6 weeks ago I was on the program and I was saying our valuation for the index was around 4,000 to 4,100. As of close today, we were 4,121. So look, I think the market has come back to more fair value levels. We thought it was expensive before, it's not fair value. So look, if it falls even further, that we think that's an opportunity to come into the market.
Also got our first caller on the line, so let's go to Ken from Brisbane. Ken, welcome to the program. What's your question tonight?
Yeah, I just wondered if the panel could tell me what they think of Jumbo Interactive, the online Oz Lotto group.
Sure. So having a look at Jumbo Interactive, this is a company with a $55 million market capitalisation. I think at the beginning of the month, coming out with a very positive announcement with an upgrade to its profit outlook. I think it is looking at increasing its profit by 23 to 29% in the current financial year. So interactive lottery business, I guess it's mostly a marketing or a customer database type of business. Russell, what do you think?
Interesting that this has come up because we only just recently met with analysts and quizzed them about this business. So Jumbo Interactive is obviously Oz Lottos. It owns and operates the ozlottos.com website. It does Powerball and Oz Lotto on the main, and also some state-run lotteries in New South Wales. We think that business, the state-run lottos in New South Wales, is under threat with Tats buying the license in New South Wales. So it's going to be interesting to see how much market share they lose there. Look, it does look like a good business. It's a business that's been built up over a number of years, and it looks like it's starting to get some scale. They have around 50,000 to 100,000 clients on their active clients on the database, and a total of a million clients. So if they get more clients spending through their website, I mean, the prospects for this business look quite bright. Also, their expansion into the US looks okay. The only thing you have to watch there is they haven't won a license in one of the 44 states that are going to issue state lottery licenses now. And also the amount of capital they're planning to spend on each state is around $2 to $3 million. So we think that's going to be quite a heavy negative for earnings in 2-3 years' time. But saying that, it looks like a fairly reasonably high quality business. It's got significant cash flow, significant free cash flow, no debt, and it's one we've looked at, but we haven't invested.
We've got Brett on the line from Sydney. Brett, welcome. What's your question tonight?
Oh, hi, mine's regarding Seven West Media. A lot of analysts don't like it, a lot do. But one thing that's caught my eye, at the current price, you're getting a yield of 15% fully franked. That's even taking into account a downgrade in its dividend this year, which is about 36 cents fully franked. At this price, and another thing I like, the directors keep buying up the stock now, Stokes and Seven Group and the other directors keep buying it up. So at this price, at 15%, that's 2 Telstra dividends in one.
It is a massive dividend. Even the forecast dividend yield on this stock's about 13%. So Seven West Media, the last announcement we heard, though, wasn't a good one. It was a profit downgrade. And of course, most of its revenue for this stock comes from free-to-air television with the Western Australian newspapers as well. So has all the bad news been filtered out of a stock like this, Russell, or should you still be cautious? 13% dividend yield. I mean, a really good point by Brett. Would you be buying in it for its yield?
It does sound amazing, doesn't it, a 13% dividend yield? And it's times like that when you do start to get interested in the business. But look, it's not a company that we look at on a regular basis. So look, the profit downgrade is a bit of a warning flag to me, which would tell me that that dividend yield is potentially not sustainable. So when you have profit downgrades, you can expect cash flows to come off, and those cash flows fund your fully franked dividends over time. So in expectation of lower cash flows, you can expect a more conservative capital allocation management policy from management and from the business. And I would expect that that dividend that you mentioned, Dave, of Brett, of 36 cents, I would expect that to come down. So expect the dividend yield to come down as well. Look, I'm using a program tonight called Scaffold, and we have a valuation on that business of around $2.70, and that's basically where it's trading. So that takes into account the capital growth of the business as well as any dividends as well. So look, I think it's fairly valued around these prices, assuming that there's no more downgrades from analysts to come through, which after a profit downgrade there's likely to be.
Welcome back to the program. Tonight I'm talking shares with Stephen Hogan from Novus Capital and also Russell Muldoon of Montgomery Investment Management. So if you've got a question you'd like answered, our phone lines are now open and the numbers on your screen, they're 1300 30 34 35, or you can also email in at yourmoney@skynews.com.au. And we've got Anthony on the line from Melbourne. Anthony just came back from Melbourne. It was beautiful on the weekend. What's your question for our panel tonight?
Hi, thank you for taking my call. I'm calling about MCE, Matrix, Composite and Engineering. I bought it as a Quinterian type stock 2 weeks ago at about 310, and I realised it's gone into a trading halt. I believe they've got some cash flow problems from what I could tell, because their order book there's a bit of lag when contracts come on and off. So to just get the panel's opinion whether I should hold this stock or as a contrarian plan look at something else? Thanks.
Sure. So good question there for Matrix Engineering. I mean, I guess having a look at some of these mining services companies have done it extremely well. This one's gone the other way. Russell, what do you think of?
This is a business we've owned in the past. I think we originally bought it just after it floated for, well, it was a few months after it floated for around $3. We rode it all the way up to $9 to $9.50. We participated in the capital raising, the first capital raising at $8.50, and then we subsequently sold for around the $7 mark after a half-year report, which shows what you mentioned was some cash flow issues. Now those cash flow issues have persisted for a good 12 months now. Unfortunately for this business, they've invested quite heavily in a new manufacturing plant in Henderson over in WA, and it just really hasn't paid off for them at this stage. The orders, as you suggested, haven't come through. So I suspect that this trading halt now is going to be an announcement that yes, they are having significant cash flow issues, and they'll probably do another capital raising to shore up the balance sheet and maybe to keep their bankers happy. So look, in a business that is under that sort of financial stress, we're just not interested. So until we see some orders come through, until those cash flows start coming back into the business and the business can self-fund itself, we're just not interested. Okay,
I hope that helps you out, Anthony. Let's go to our next call. I've got Simon on the line from the Central Coast. Simon, welcome. What's your question tonight?
Good evening, Julia, Russell and Stephen. My question's in relation to Toll Holdings. I know it jumped a little bit today, about 4%. My question is it the panel's opinion on whether it's a worthy stock to have in a portfolio for the purposes of yield and some capital growth? Thank you.
Good question coming through from Simon. Toll Holdings usually seen as a bellwether of the Australian economy, and it looked like it was on the path to recovery. I mean, we saw those massive profit downgrades through the global financial crisis, and then looked like recovery, and now we've seen another profit downgrade coming through. Look at a company like Toll, and we've seen this profit downgrade. It was a downgrade of about 20% to what consensus was. They're citing tough retail conditions, but you know, we've seen some impairments. They're looking at selling off one of its smaller businesses. Are the decks clear?
Are the decks clear? That's a fantastic question. Look, it's not a business that we follow, and I can tell you for good reason. We use a program called Scaffold, which rates every company from A1 down to C5. This company gets a C3, so it's right at the end of the lower quality. And you know, at the start of the show, I talked about you only want to look at quality businesses. This is right down the end of the spectrum for us, so it's not a business that we can consider. But I can tell you, in terms of the downgrade that's come through, our software ups every day for consensus analyst forecasts, and we have a valuation around the $3.70 sort of level. So we'd want to see a significant discount to that to buy low quality businesses, a low quality business compared to some of the companies that we can buy at the current market prices. So look, is it all over? Like a C3 tells us that there's a significant amount of goodwill on the balance sheet. And with the rates of return on equity that this business is generating, I would say no. I would say there's more to come in a tough economic environment.
Okay, so pretty tough for Toll Holdings, and really you want to see it recovery in some of those key sectors for Toll Holdings, the retail sector, the domestic economy as well. Let's go to our next caller. We've got Eric on the line from Sydney. Eric, welcome to the program. What's your question tonight?
Thanks, Julia. Look, just asking the panel on their opinion. One, I'm a long-term holder in Blackmores. Saw in the fin review the other day Swiss apparently upgrading its spend in Australia, but I go to Coles today to see the outlay is about 10 to 1 Blackmores to Swiss. Just if Russell and Steve could give a technical and fundamental. Thank you.
I mean, this is a good question. Blackmores, it's a very well-known retail brand. We know that retailing is tough. Does it hit vitamins, Russell?
I don't think it does. I think I would classify Blackmores as a healthcare company. I think healthcare is a very, very stable industry, especially with age and demographics. People want to look after themselves. They're taking bio oils. They're taking calcium for their bones. Look, I think that's a rising tide that's going to lift Blackmores into the future. But this is a fantastic company. Make no mistake. And Swiss are coming at them very, very hard to take market share in Australia. These guys are the market leaders. They have been for a significant amount of time. And you know, in terms of quality, you know, we talked about Toll just before being at the bottom end. This business is at the top end of the market, and you know, naturally, because it is one of those high quality businesses, it does seem to always trade at a premium to what we think the business is worth. We have a current valuation of around the $26 mark. So look, yes, Swiss is coming at it very heavily, and you see that in TV advertisements every single day. Will they make a dent into Blackmores? You know, time will prove that. But look, it is a well-run, well-managed business with a fantastic outlook.
Let's go to our next caller. We've got Andrew on the line from Brisbane. Andrew, welcome. What's your question tonight?
Yes, hi Julia. Just the panel's view on the ASX 200 and as it moves through the year, and also when is it likely to turn around?
It's a difficult environment to be crystal ball gazing, but I'll ask both our panellists to get out their crystal balls. And I guess, is Europe going to disappear or not is the key question. I mean, Russell, what do you think?
Look, on the ASX 200, like I said at the start of the show, and what I've been saying since the start of the year, way back in January, our valuation for the ASX 200 was around the 4,000 to 4,100 mark, close to that 4,121. So we're right at fair value. I mean, if we can obviously get a discount to that, you know, if you're an index investor, this is probably the time you would start to look at the index. But the ASX 200 is so heavily weighted in resource companies and financials. I think 40–50% of the index is made up of those two sectors alone. So if you are investing in the ASX 200 and wondering where it's going to go, you really have to have a view on those two key sectors of the market, and in particular resources. Last time I was on the show 6 weeks ago, we were quite bearish on resources in general. Our view stemmed from the fact that Europe is in quite serious trouble. US is muddling through, and China export markets, two of the largest export markets, of course, of Europe and China. So if Europe is slowing and contracting, and the US is just maintaining status quo, then naturally demand for exports from China has to slow. So demand for resources on Australia's side has to slow. So that's what we're seeing. We're starting to see that now. We're seeing commodity prices come off. and profits potentially for mining companies come down. So in that sort of environment, maybe, and I'm hoping that the ASX 200 continues to fall and it drags down a lot of high quality companies in its wake.
Lots there. Welcome back and thanks for joining us. If you'd like to get in on the conversation, our phone lines are open, so the number's on your screen there, 1300 30 34 35, or you can also email us at yourmoney@skynews.com.au. And we've got Sean on the line from Brisbane. Sean, welcome. What's your question tonight?
Hi, Julia. Thanks for taking my call.
You're welcome.
Two stocks that I'm interested in the energy sector, given that it seems to have been smashed lately.
I'm interested to find out which stocks.
Yeah, well, two growth stocks. One I'm looking at is Paladin Energy in the coal sector.
Sure.
In Queensland, they've got a fairly big deposit, fair bit of money in the bank, and some good shareholders.
And
the other one, Dart Energy, which has absolutely been thrashed. They're run by the old Arrow Energy guys. And unfortunately, they're not doing too much in Australia, but most of their footprints globally. They're also cashed up. They've got HSBC willing to lend their money as well. Some good projects coming through in the future, so I'm just wondering if these boys have heard of them.
Okay, so Sean, I guess this is a question that a lot of people in the market are asking themselves at the moment as well. We have a look at Bandana Resources. Most of its value comes from the Bowen Basin, and if we have a look, they're at advanced feasibility stage for both the thermal as well as their coking coal projects. But this type of market environment, I mean, it's a difficult one. And then you've got Dart Energy. It's an exploration company, no earnings, no cash flow as yet. What do you think, Stephen? Would you be backing them now while they're down? Is this the lowest they're going to go? Is this a bar? I mean, Russell, just strategically in this type of environment, a lot of people who are chasing some of those mining companies before they get into production and cash flows coming through the door have been hurt quite significantly. Any words of perhaps advice or tips for them in this type of environment?
Probably advice. I never give tips, but definitely advice. Look, our guiding principle at Montgomery Investment Management is that the return of your money is always more important than the potential return on your money. So what that means is, we're very cautious investors, and we want to make sure that our clients' funds are going into high quality businesses where we're pretty sure that the risk of capital loss in the long term is very short, is very low. And in this environment, as Julia just mentioned, yes, I think Bandana has around $60 million of cash at bank, and Dart Energy has around $140, $150 million in cash. But these are big assets which require huge infrastructure developments to get them up and to get them producing. So is that going to be enough cash to get them through from their current feasibility studies and into production and into generating cash flows? And that's a serious question that we would have to ask. In that light, there's a lot of businesses that are already producing, already making significant cash flows. And there's a lot of high quality infrastructure assets out there as well that are very, very steady earners, like the Ethane Pipeline Trust, if you're interested in the gas sector. So look, I just prefer to err on the side of caution at the moment. These businesses are going to, especially in the small cap environment, small cap land, are going to find it very, very hard to raise capital from investors with the high risk nature of their projects. Look, I would just, we don't invest there, and I wouldn't be investing there in this environment.
Okay, so some words of advice there coming through from both our panellists. Let's go to our next caller. I've got Andrew on the line from Geelong. Andrew, welcome. What's your question tonight?
Yeah, hi Julia and panel. Thanks for taking my call. I've basically got a self-managed super fund, and I've probably made the worst mistake you can do in this environment and just let the portfolio run on its own for a little while. And there's been a couple of stocks that I've found that have performed very poorly, and I guess I'm just sort of wondering whether I should cut my losses on them and take a hit and reinvest the money in something that would be a better return. And the two that I'm thinking of are Paladin PDN and Think Smart, and I'm just wondering the panel's view whether I should try and just hang out with them or whether I should just take my losses and go elsewhere.
Andrew, can I ask, are you looking at a long-term investment because it is part of your super fund, or are you looking more medium-term, maybe 2 to 5 years?
Yeah, look, I was really looking long-term, but then, I sort of listen to this show a lot, and a lot of people seem to be saying, some of these you're probably better off just getting out of and getting more defensive stocks or looking for better options, I guess.
Sure. So I guess Andrew's asking in regards to a super fund, which is a little bit different from a lot of our callers who are trading or looking to time their way into some of these stocks or pick them up for investment. So having a look at a stock like Paladin as well as ThinkSmart, a lot of people were talking about how uranium stocks were looking quite cheap, especially in 2012, but that was really dependent on, the price bouncing back somewhat, as well as demand bouncing back somewhat. So a stock like Paladin, cash flow is looking a little bit tight. Perhaps if we see maybe an asset sale, that might help it along. But if we don't see a recovery in prices, I mean, what do you do with a uranium company like this?
Yeah, I mean, uranium is a bit of a dirty word with what's happened in Japan recently, isn't it? Look, I think, I'm not sure the exact number of nuclear reactors in Japan, but there's between 40 and 50, and they've pretty much shut down all of them after the Fukushima disaster. That reduces a significant amount of demand out of the market, and with supply staying steady or supply rising, that's a detrimental impact on prices, and that squeezes cash flows. It squeezes the ability for this business to expand its infrastructure and to go ahead. And that's our main fear for the resource sector in general at the moment, with declining commodity prices. What impact is that going to have on BHP, Rio, and their cash flow going forward, and their capital expenditure plans and mining services? So Paladin we don't own. We don't own any uranium. We sort of have more of an ethical bias. Not saying that everyone should, but that's just what we do. We don't invest in uranium, so we're not there. In terms of ThinkSmart, I mean, this business operates in an industry which is very tough at the moment. It's in retail. It does finance leases on laptops and PCs, and does that in Australia for JB Hi-Fi, and it does that in the UK as well, where they've been trying to expand for a significant amount of time. It's tough out there. The Thorn Group result today is another finance lease business. It's showing that if you take out the NCML acquisition, that business is doing quite tough in PCs, in flat panel TVs as well. And 2013, I just don't see any growth in that business. So look, it's a tough environment. Would I be selling here? Look, you'd have to have a view on whether or not you expect the world to recover and to the Australian economy to recover and retail spending to increase. That will be a key driver of ThinkSmart's earning into the future. Look, if you take analyst forecasts at face value, Scaffold has a valuation of around the 40 to 50 cent mark in 2012, 2013. So look, it looks cheap on that basis, but analysts are prone to being optimistic and expecting a recovery when there may not be one. I mean, you just have to take your view on that.
Okay, so it depends a lot on retail for ThinkSmart and Paladin. Well, one day we'll get back to using more uranium, but for the time being, tight cash flows, maybe you want to see some alleviation of, I guess, tight cash flows we are seeing. It is time for a quick break. Before that, though, time to start the stock watch. So, Russell, what are you watching?
We own in the Montgomery private fund, and indeed it's our largest position in the fund at the moment is Seek.com. The ticker code is SEK. We are firmly of the view that we should always buy a wonderful company at a fair price and a fair company at a wonderful price. In that regard, Seek is a wonderful business. The share price has recently fallen from, I think, $7.50 down to $6.70, so the price is fair, and we've been accumulating our position. We think, in light of where the share price is, it's one to watch.
Welcome back to the program. Joining us in the studio tonight, we've got Stephen Hogan of Nervous Capital and also Russell Muldoon of Montgomery Investment Management. So if you'd like to get in on the conversation, our phone lines are open. Please give us a call. The number is 1300 30 34 35, or you can also email us at yourmoney@skynews.com.au. And we've got Bill on the line from Melbourne. Bill, welcome. What's your question tonight?
Good evening. Thank you for taking my call. Just wondering whether I could get an intrinsic value from Russell on Silverlake Resources.
Okay, so having a look at SLR, Silverlake Resources. And while we have seen the gold and silver prices jumping back quite aggressively over the last couple of days, I guess Silverlake more a gold company than a silver company, the share price of Silverlake has done the same. So in terms of an intrinsic value for a mining company like this, what do you think, Russell?
This is actually a business we own in the Montgomery private fund as well. We don't have a large exposure to gold. I think it's less than probably 3 or 4% of total invested funds. But to answer your question directly, we have around $3 this year, rising to about $5.50 next year. The reason we're going to see that rise in valuations, that's if analysts' forecasts come true, is that the business is expanding its production profile. So it's going from 100,000 ounces today to 150 to 200 to 250 in the next 2 or 3 years. So we're going to see a significant amount of production. The cash costs for this mine are around $800 an ounce, $700 to $800. So there's even with the gold price falling, there's significant margin for this company. So we still see bright prospects for this business. I know a lot of people have a view on gold price. You know, if Europe does fall into a mess and central banks do come to the rescue around the world, we're going to see another round of money printing. That's very supportive of the gold price. But that's not our position to speculate on where the gold price is going to go. We're very conservative on our forecast for the gold price that we put into our models and our assumptions. And you should be when you play in a commodity, a currency type product like this. So around the $3 mark, rising to $5.50 next year.
Time for an email. We've got one here from Joanne, and Joanne asks, I'd like to ask the expert panel for the valuation and fundamental analysis of Qantas. A relevant one, given that we heard that Qantas is going to split into its domestic and international parts. Russell, what do you think?
Hi Joanne, and I hope you're well. I actually know Joanne. She's a friend of mine. So she said she was going to ask the question tonight. So hi and hi to Malcolm.
So you're all
well.
prepped up and prepared.
I didn't expect it to get through, so I wasn't actually prepared for it. Look, Qantas is a highly capital-intensive, highly competitive business. It's a business whose valuation has gone nowhere for 10 years. It's forecast to go nowhere. It's got rising jet fuel costs, it's got union issues, and now what we're going to see is we're going to see Qantas split into two businesses, and we're going to have a capital-intensive business, competitive business on one side, we're going to have a capital-intensive competitive business on the other side. So look, it does make sense with the split, but to answer your question, Joanne, I have a valuation of around the $1.20 to Scaffold has a valuation around $1.20 to $1.30 at the moment. Look, it's just not a business that we've ever been interested in, and I don't think anyone should be invested in airlines. So
Russell, if you and Joanne are friends, why couldn't she just have asked you?
One thing to watch on the split as well with Qantas is, look, Asciano, when it split from Toll, all the debt went into Asciano, and we saw what happened with the share price. Just watch out that doesn't happen.
That's all we have time for today. Thanks so much to our guests, Stephen Hogan of Novus Capital and Russell Muldoon of Montgomery Investment Management, and to you, our viewers, for all your calls and your emails. Until next time, I'm Julia Lee.